Good afternoon. Good afternoon. It's the 3rd of March. Welcome to another edition of Monday Market Picks. My name is Tilan Vikramasinghe, the head of research for Maybank Securities here in Singapore. We're seeing tantrums all over the place in the White House, from geopolitical with Trump and President Zelensky, to trade, where we are seeing a barrage of tariffs being threatened from China to Canada to Mexico. So around all this, we're looking for tantrum shelters, and we think Singapore is one of those countries where you can find some shelter. Our macro team actually says that some of these tariffs might actually be deflationary as some of the global excess capacity gets shifted to Asia, and that might actually drive inflation to be lower in Singapore, and they have actually cut overall inflation target for 2025 as well. But there are some negatives as well. One negative implication is in the Singapore manufacturing sector, which is struggling with low demand. We have Jarek joining us on the show to discuss what that means for AEM and Frencken. And then we stay with Jarek to talk about a positive, particularly this stock, which has been a big underperformer for most of last year. And now we think this is going to be a big turnaround story this year. And then we have Krishna joining us to talk to us about ST engineering, especially as global uncertainty around defense increases, and why he's recently upgraded this stock to a buy. And I'm going to talk a little bit about OCBC, where I've downgraded this stock, and I think that the better bet is UOB. And we also have our chart guy, Amirul, joining us to talk to us about two trading buys as well. So without much further ado, let's have Jarek on the line. Jarek, welcome to the show.
Hi, Thilan. Thanks for having me.
Now, Jarek, you cut AEM's target price to 1.07 from 110, and you're reiterating the sell call that you made. This is after 2024 results actually turning out to be better than expected. So what's driving this negative view?
Sure, if you look at AEM in a whole, basically they are going through a transition phase where they are getting 3 to 4 new customers, but they are slowly ramping up with these customers one by one at different time periods. But however, I think their revenue from their key customer is actually coming down quite significantly. So Intel on every angle is losing market share to their key competitors in every segment. So that has resulted in sales from Intel to come down significantly, and especially for FY25, because they did a pull-in order in fourth quarter, where they actually draw more machines, which means that actually they will actually order less for FY25. So if you look at AEM's valuation, basically even for this year, when we raise our numbers, currently it's still trading at about 20 times FY25 PE. And we do think that that is because you need time for the new customer to ramp up, especially in the next 2 to 3 years. So basically, we think that currently it's still in a transition phase. Even though earnings will improve, our valuations still remain a far-fetched from, I would say, the normalized valuation that they should be trading at. And I think that this story will take about maybe at least another 1 to 2 years before earnings can catch up with this valuation. So as a result, we do think that AEM is still quite expensive, and there's also execution risk. For ramping up with these customers, is not 100% certain that they will be successful. So it's now you're overpaying for, I would say, you're pricing in perfection if they were to be successful. So I think that it's still a few quarters too early, before we were to upgrade to a buy, depending on how they ramp up with their customer.
Got it. So expensive valuations and a very, very long runway before they can actually get to recovery.
Mm,
Got it. So sell on AEM. But
mm,
now, despite the structural pressures that you're seeing in this sector, you're still keeping a buy on Franken.
mm,
But you've still cut target price by a big 20%. So let's
mm.
start with that and what led you to cut the target price. And also then let's talk about why you think this stock is still a buy.
Sure. If you look at the whole Trump, tariffs, and also the US and China trade, the trade war, and also basically the limitation on semicon, the reason why we cut our target price is basically we cut our PE from 14 times to 12 times to price in all these macro conditions, which may cause uncertain demand for their customers' product. So I think the main cut is because of all these macro factors and also the potential limitations that the semicon sector might face going forward with Trump and China, still going against each other. So basically, we are cutting on valuation. But if you look at basically fundamentals for Frencken, it remains quite strong. We expect basically they expect semicon revenue to continue to increase in first half of 2025 as compared to second half of 2024. And that is mainly due to its key customer in Asia, Applied Materials, as well as ASML, also moving production from Europe to Southeast Asia, more of Singapore. So basically with that, they expect semicon revenue to be remain higher for first half of 2025. And for second half of 2025, we do expect semicon revenue to be better as well because the semicon uplift is expected to come in second half, which was delayed from 2023 to 2024 and now 2025. But we will have to wait until April or May for more clarity on this uplift. And they also announced that they're expanding in Singapore. So if you look at their two key customers, AMET and ASML, AMET is also building a new factory in Tampines, right? So they are expanding the capacity in Singapore. And so we do think that Frencken, which they announced, which they said they are exploring to, expand in Singapore, would be to cater to these two new customers. And with that, we do believe that, the customer must have sort of promised Frencken something for them to put this capex, for a new factory. So we do think that the outlook for Frencken likely for these two new customers is actually quite positive in the long run. So with that, speaking with that, all the limitations and all the potential macro risks, we do still think that Frencken is still a top pick because they are actually a key beneficiary for this. Just that the macro environment is still quite uncertain now for the whole sector. So that's why we downgrade our sector PE. But in terms of fundamentals, we still think that Frencken is one to benefit from this semicon uplift, if any. Yeah.
Got it. Got it. It's still a hard sector, but
Mm,
the only stock with a slightly brighter outlook, I guess.
correct.
So let's
Yep.
turn to something a little bit more positive.
Mm,
Let's turn to this consumption play that was a big underperformer last year, Food Empire.
mm.
Jerick now upgraded this stock to a buy. The company faced quite a few issues last year, including some issues with their Russian partner. What's changed now, and what's kind of driving your optimism for this stock?
Sure. So basically, I think last year they faced some key issues. One is with their partner, their distributor on pricing. Second is raw material pricing, like your coffee prices shot up the roof, and also your creamer prices also shot up. So what has happened last year was a dip in profits. Basically, you see profits dropping by close to about 10% last year. And I think, but this year, basically in the last, I would say 3 to 6 months, management has also put in price increases. So they have put 2 rounds of price increases already, which we do see that this should start to flow in the first quarter and second quarter numbers next year. So we do expect margins to improve for FY25. And I think there's still another 1 or 2 price increases more to go. So you start to see margins start to improve first quarter, and Q on Q, it will start to improve further as the price increase take effect. And another key thing to note is that they have sorted out their problem with the Russian distributor. They have settled, and going forward, now basically they have to wait for this. When the Russian distributor sign, they sign contract for 6 months or 1 year. So once this contract expires, the volume will then come back to Food Empire again, because they've sorted out the issue. So we do expect revenue from Russia to improve as well going forward. Next, it would be, I would say, the most important one would be the diversification of revenue. So Food Empire is always trading at a very low valuation because of its Russian-focused revenue and profits. But Vietnam has turned out to be a star out alignment where Southeast Asia, Vietnam actually grew close to about 50% revenue year on year, and now Southeast Asia is almost as big as Russia in terms of revenue contribution. And going forward, they also have another plant in Bangladesh upcoming, and also expansion in India as well. So, and sorry, not Bangladesh, sorry, Kazakhstan by the end of 2025. And also in Vietnam, there's a freeze-dried soluble coffee manufacturing facility which is expected to complete by 2028. So basically, you're looking at Food Empire further diversifying its revenue from Russia, and hopefully by then basically the valuation for Food Empire should go up. I mean, if you look at PS, they are trading at about 15 to 20 times. Food Empire is only currently trading at 8 times PE for this year. So we do think that, with the diversification of revenue, improvement in margins, and this year we do expect profit to grow uh, uh, for FY25 as compared to FY24. That's why we think that at 8 times PE, it's actually quite worth to upgrade to a buy, and we do think that, valuation should improve going forward. Dividend is also quite attractive at about 8% yield. So we do think that a 7+% yield. So we do think that shareholders will also be rewarded with good dividends going forward as well. So that's why we upgrade to a buy.
Got it. So good yield, cheap valuations, a lot of the headwinds of last year starting to go away. So quite a few things to watch out for. It's opportunity plus high conviction stock. So do have a read on Jarik's note in our newsletter today. Thanks, Jarik. Let's turn to OCBC, who posted results last week along with some enhanced dividends. Their fourth quarter results were in line. Actually, I would say they were slightly more disappointing. Part of that weakness was the insurance operation, and the business there actually introduces a lot of volatility compared to the other two banks. On the banking business, we're a lot more sanguine, and their one OCBC strategy seems to be playing out. The bank has been connecting Chinese customers with ASEAN investments, and they're especially well set up to benefit from the Johor Singapore SCZ as well. Now, at the same time, the fees were a lot more robust than what we saw with DBS and UOB, especially when it comes to wealth management. We did not see much of a drop-off in fees in the seasonally weaker fourth quarter, and management is saying that the run rates in first quarter is actually quite strong. Also, they're doubling down on Great Eastern and looking to push more Great Eastern products to OCBC customers. Overall, we see this strategy trying to extract synergies from the bank, from wealth management and insurance, and they're having some success there. Now, that should be positive for core dividends going forward, and this has led to us upgrading the target price a little bit. However, this is not enough to keep a buy. The market is looking for a lot more capital returns, and OCBC's capital returns are going to make a smaller impact than for DBS, than what DBS and UOB are doing. The mix of about 1.5 billion special dividends and 1 billion in share buyback implies about a 5.9% yield compared to UOB's 6.5% yield. And the buybacks, and if you cancel those buybacks, will accrete EPS by about 1% versus UOB's 3%. This means that OCBC will continue to generate a lot more excess capital that will keep their ROEs suppressed. So that's why we are downgrading this stock to a hold. Now, we think that to own a bank, you're better off owning UOB. As we said, they're returning a lot more capital to shareholders, so you know what you're getting, and at a much higher yield as well. Plus, their ASEAN footprint is actually in a very, very good position from all these tantrums in terms of getting supply chains moving from North Asia to Southeast Asia, and they will be able to get market share there. They've also been investing a lot on their consumer business after buying Citibank, and we think that's naturally a higher ROE business. So the ROE should actually increase by around 3 percentage points going into the next 3 years, while OCBCs will most likely be flat. So we have a buy on UOB, and while we have a hold on OCBC. Now, with that, let's turn our attention to ST Engineering, and let's get Krishna on the show. Krishna, welcome to the show.
Thank you, Thilan. Just a minute, I think. Hold on, the video should be coming up. Yeah, okay.
We can see you, Krishna. Now,
yeah,
you
thank you.
the stock ST Engineering to a buy, and you also raised the target price by around 21%. What's actually driving this, and what's giving you this optimism for your upgrade?
Thank you, Thilan. So I think four key reasons. The first is the execution, which you can see from their results, and also the record order book, which provides the earnings visibility. So if you look at our forecast, then we are expecting about 17% growth in the earnings on annual growth for the next 3 years. Second is the favorable tailwinds that is coming through from the uncertain geopolitics. Obviously, we want peace to prevail, but STE does benefit, especially for the defense business, from this sort of macro situation. Third, I think management has sharpened their focus on the cost management side of things, which is very important. And given this inflationary setup, and there, if you look at the OPEX to revenue, then it is on the best metric over the last 4 or 5 years. Finally, the nascent turnaround around their satellite communication business. This came as a pleasant surprise in the fourth quarter results. It is not a big contributor to their top line, but has been a drag for some time to the bottom line. So I think these four reasons are the main ones which led to the upgrade and the increase in the target price.
Got it. No, actually, you mentioned about defense, and I want to stick a pin there. We are starting to see increasing defense spending. I mean, Europe is saying that they're increasing their defense spending as a percentage of GDP. We're also seeing defense spending increasing in Asia. How do you think that will actually play out for ST Engineering, and any sort of past examples or past comparisons that you have?
So I think STE is a proxy to defense spending, definitely in Singapore. And also, I think after they have embarked on this strategy of internationalizing their business, they are also benefiting from the geopolitics that's happening in especially in Europe. So you rightly pointed out about the increase in the defense to GDP ratios. I think if you look at the Singapore numbers, they have also come up. So STE will benefit from that trend. But more importantly, I think apart from that, they are also trying to deliver a cost-effective solution to their counterparties in Europe, which is quite important given some of the traditional linkages are a bit more fluid currently. And also to take a bit more prudent approach, they are not establishing in-country manufacturing capabilities. They are going more for a partnership approach. So I think there are tailwinds, and then STE from its own standpoint is taking a bit more of a prudent approach in deploying its balance sheet. So I think these definitely augurs well for the defense business for STE.
Got it. Now, one thing that I noticed was that the dividend yield is a little bit low. It's about 3.5% or so. Do you see this changing over time, especially with a bigger order book?
Yeah, I think this has been a sticky point for quite a few investors who are looking, who probably look at Singapore market as an yield market. So I think a couple of points I will mention there. First of all, management has increased the dividend by 1 cent. It was 4 cents quarterly dividend, and last quarter it was 5 cents. So that definitely is a good starting point. And I think we have also increased our full year dividend estimate from 16 cents to 18 cents. That said, I agree that it does not kind of move the needle massively, but I will say a couple of points on that. The first is that investors should look at the stock more as an yield plus growth play. And I have mentioned that we are forecasting about 17% of earnings growth of the forecast period. And given that this growth in earnings is coming through, we do think that STE is in a position to potentially increase their dividend, and barring any large M&As or any other negative turn in their top line. So I think yes, the yield is low, but there is potential to increase it further.
Right. So yield can be increased further. Actually, there's a question from the audience saying that this stock's 589, target price 570. So any more room to upgrade the target price? You think we have a few more levers?
Yeah, I agree that I have been sort of catching the stock, and the operational results have clearly come up above my estimates. and the last quarter's order wins also have been quite strong. So I think as long as we see STE continue to keep adding to the order book and continue to execute without any cost overruns, there should be further upside as well.
Got it. Thanks, Krishna. With that, let's go to Amirul, our chart guy. He's joining us, and Amirul's got a couple of trading buys. Amirul, what have you got for us?
Hi, Thilen. Thanks for having me. So we have two new stock ideas for today's show. So let me share my screen first. So the first stock idea we have for today would be one moment. Would be Pan United. Stock code P52. So basically why I recommended this stock today is because number one, because it actually made a strong rebound from its current support line. So if I just draw line over here, so this is its current immediate support line. So if you look at last Friday's movement from this candle, this green candle over here, it has actually rebounded stronger with volume higher than average. And you can see with this rebound, it has pushed the price back above all key moving average lines because it is now back above the 21-day moving average. And the surge in trading volume last Friday convinced me that there would be another rebound that might follow suit soon. So today, as of this morning, the price did not go unchanged, but then overall the bullish sentiment remains positive. And if you look at the support line over here, it actually aligns with the orange lines, which is the 50-day EMA. So I believe as long the price remains above the 50-day EMA, which is now acting as a very important support line, the bullish sentiment remains outlook. However, if the price breaks below it, then probably the uptrend that has been formed since December 2023 low might find a reversal moment. So that's it for Pan United. So the second stock idea would be UOL, stock code U14. So basically why I recommended this stock is because it actually just made a strong bullish reversal move. So if I draw a line from up here to down here, and I draw another line from down here to down here, this is what we call a falling wedge pattern breakout. So the price has broke from this level around this big candle over here on 24th of February last week. So price not only took out its 21-day EMA, 50-day EMA, but also has touched the 200-day EMA before it just broke above this line. So you can see after that, the price has been gyrating between the 200-day EMA, and the price movement last Friday has convinced me that it could actually break above the 200-day EMA another time today because of this surge of trading volume last Friday. And if you look at the moving average lines right around here, there's a moving average crossover where the 21-day EMA has just crossed above the 50-day EMA. And if you look at the price this morning, this moving average crossover signals a stronger bullish momentum, signals like this downtrend, this sharp downtrend that has been formed very, very long time ago has subsided. And I believe the maintenance above this 200-day EMA line could be formed because of the price movement this morning. And if you look at the MACD reading, it is also nicely sloping upward. And the other side still has room before the overbought zone. So possibly the price could actually gyrate between, not between the 200-day EMA, but actually gyrate above the 200-day EMA, possibly making a move like this before it actually bouncing higher. So take a look at UL. It has a nice potential to have a stronger bullish reversal move. So that's all from me, Thilen. Over back to you.
Excellent. Thanks, Amirul. Quite a few events coming up in the next couple of weeks. PMI numbers coming out today. Retail sales, which has been a bit touch weak recently, coming out on the 5th of March, and FX reserves, and all important unemployment numbers coming out on the 10th of March as well. With that, we're out of time. Thank you so much for joining us this week, and we'll see you next week. Have a profitable trading week.